Good afternoon, ladies and gentlemen, and welcome to the announcement and the call on the full year 2018-19 results. Let me begin first with certain highs and lows for the year and the industry trend. For the Indian hospitality, the demand growth has been outpacing the supply. There has been a sustained RevPAR growth and an average rate growth of 2.9% and an occupancy growth of 80 basis points. However, on the low side, the year saw the outbreak of Nipah virus, Kerala and Karnataka floods, a depreciation in the rupee, and a turmoil in the airline industry. Most of the markets performed very well, with the exception of a couple of markets where I would say Goa came from a very high of the average of last 10 years, so there was a marginal decline, but the maximum decline was only in Kochi. In all other markets really did quite well, especially for our portfolio also. In terms of the key highlights for our performance for the fourth quarter, our revenue grew by 10%, our EBITDA grew by 21% to 322 crores. Our EBITDA margin went north of 25%, an increase of 230 basis points, and an increase in profit after tax of 52% to 115 crores. When we look at the full year, it's even a stronger performance with a 10% growth in top line to almost 4,600 crores, an EBITDA of 25% increase to an absolute amount of 913 CR, an EBITDA margin of almost 20%, an increase in 229 basis points, and a profit after tax of 287 crores. This is the highest profit after tax that we have posted in the last 11 years. When it comes to our pipeline, we were able to manage our pipeline as we have given the guidance based on Aspiration 2022 by signing 22 new contracts amongst all our brands in the full financial year, and added another 4 signings which you must have read about. A few of them have been announced in the month of April. Some of these signings are iconic assets both within India as well as in international markets like Dubai or London Heathrow. More importantly, we have given the guidance of having a balanced portfolio in which we would have 50% fee-based business contracts and 50% leased or owned. And today, as the portfolio stands, after this financial year, we've been able to increase our management contracts from 32% to 40% of the portfolio. So there is a clear shift in the business model as we go forward. The year also saw 5 new openings and 500 plus keys, and we have given the guidance already in different media forums that we will be opening a hotel per month in this financial year. And we started the year with the opening of Siddhartha Goa in Goa. We finished last year with the opening of Simla and Rishikesh, which you see on this slide. And the ones in May and June we are going to announce, and for the remainder of the year also. But we are very confident to open 12 hotels in this financial year. In terms of some of our important assets where we had been struggling and everyone was reading in the newspapers, we were able to secure a 33-year term for the Mansingh in Delhi. We were able to relaunch the Connemara in Chennai, and we were able to also extend our contract with Lake Palace in Udaipur, the most photographed hotel in the world. With that, I hand over to my colleague Giridhar Sanjeevi to take you through some more details on the financials.
Thank you, Puneet. I think this is Giri here. I think what we have seen is that as a result of focus on execution on the Aspiration 2022, quarter on quarter, we have seen revenues go up 10%, EBITDA go up by 25% on a quarter-on-quarter basis, PAT go up, and EBITDA margins go up. So this is a consistent performance that we hope to sustain. In terms of the network revenue performance, what we have seen is on the domestic side, a room revenue growth of 6.9%, a RevPAR of 6%, and an F&B revenue growth of 9.7%, which is essentially strong performance and above what the overall industry has achieved. On the international side, we did room revenue of 9.4%, RevPAR grew by 9.3%, and F&B grew by 9.8%, once again demonstrating a strong performance. Coming to the consolidated Q4 indicators, our revenue grew by 10% to 1,282 crores, and EBITDA grew by 21% to 322 crores, with a margin expansion of 2.3%. On the continuing on profit before exceptional items and taxes, grew by 48% to 189 crores, and profit after tax by 52% to 115 crores. For the full year ended March 2019, our total revenue grew to slightly under 4,600 crores with a 10% growth, and EBITDA grew by 25% with a margin expansion of 2.29%. Profit before exceptional items and taxes grew to 395 crores, which represents 144% growth, and profit after tax to 287 crores, which represents 184% growth over last year's 101. Just on the details, I will just highlight the key items. Our expenditure control remained consistent, where our expenditure growth was about 7% as against the revenue growth of 10%, giving us the boost in terms of the leverage in terms of the EBITDA. Our finance cost, we had a substantial saving with a total annual cost of 190 crores as against 269 crores in the previous year. All this resulted in a profit after tax of 287 crores. Coming to standalone, the Q4 standalone was 875 crores with a 9% uplift, an EBITDA uplift of 19%, and a margin expansion of 3.3%. And profit before exceptional items and taxes were 243 crores, which is 27% growth, and PAT of 165, which is 152% growth. For the full year ended, the standalone had a 9% growth with a top line of 2,871 crores, EBITDA of 820 crores at 20%, margin expansion of 2.6%, and profit after tax of 264 crores, which represents a growth of 78%. One point to note is that after a long time, the consolidated PAT of 287 crores is higher than the standalone PAT of 264 crores, which is a good thing, showing that the rest of the network is beginning to contribute positively. The similar patterns on the standalone as well, where the expenditure control was even better at 3% growth to 5% growth for the full year, while the revenue grew by 9%, which gave us the EBITDA uplift, and the EBITDA margin for the full year was 28.56% for standalone, which represents a strong number. Interest costs went down. Profit after taxes were 264 crores, as just explained. In terms of debt, we did not do any incremental borrowing on standalone. It's remained constant at 1,784 crores. We continue to have good liquidity position of 282 crores. And net debt to equity was 0.33 in standalone, and weighted average cost of debt at 8.2, and net debt to EBITDA of 1.83. Similarly, in consolidated, our net debt to equity was 0.44, weighted average cost of debt was 7.2, and net debt to EBITDA was 2.11, which represents a 0.47% reduction from the opening net debt to EBITDA of 2.58. This is an area that we'll continue to focus on. These are the key highlights in brief on the financials, and we will be happy to take questions.
Thank you. Dear participants, if you'd like to ask a question, please signal by pressing *1 on your telephone keypad. If you're using a speaker phone, please make sure your mute function is turned off to allow your signal to reach our equipment. Once again, please press *1 to ask a question. We'll pause for just a moment to allow everyone an opportunity to signal for questions. And I would request everyone to say their name and the company they belong to before asking a question. Once again, the participant, if you'd like to ask a question through audio, I would request you to please press *1 on your telephone keypad. All right, we'll take the first question.
Hi, can you hear me?
Yes.
Good evening, everyone. This is Satyam from Morgan Stanley. I had a couple of questions. One on the cost control targets that you had outlined at the CIO event last year, where you had mentioned around 400 bips of margin improvement is what you expect by fiscal 23. And we know that in fiscal 19, you have had good cost control that you've already kind of begun with. So, if you can share any sense of how much of that 400 bips cost control target is already, done in fiscal 19 itself, and how much more is there to go on that. And the second question that I had was on the management contract side. We have had very good, healthy run rate of, new signings that we have done in fiscal 19 and further in April as well on the new management contract side. But we have, based on announcements that we hear from global peers as well, clearly it seems that, there is a lot of aggression on getting management contracts from other players as well. So have you seen any increased aggression in bidding for management contracts from your peers as well? And, as a result, are you seeing lower fees become the norm or something like that? Any outcome of that you're seeing in your new contracts that you have signed last year? That's all. Thank you.
Okay, Satyam, the first one, I would go the reverse order on the management contracts. I think, obviously, when the competition increases, there would be certain pressure, but last year we did not witness much. However, going forward, I think there could be some pressure coming on the fees by, 5 or 10%, but, the fees is what, 6 to 10% of the top line. So that is not a big number. Important is to get those plain vanilla management contracts so we can have a change in our business model. And it is also very difficult to benchmark in a heterogeneous country like India, as certain mega markets you could do with a lesser percentage of fees, as the average rate in markets like Mumbai and Delhi and Bangalore is far higher than in secondary tertiary markets. So I think going forward, what we will do is in the next quarter when we announce the results or the following quarters, we might start doing some of the analysis by brand and by geography. So I think it's very important to know it's which brand and what geography, because a smaller fee on Ginger is very small versus a smaller fee on a Taj brand in Mumbai or in Delhi. So I think that factor we will put in going forward. The second one is on the cost side. We did say that our 800 basis point margin expansion will come 300 to 400 basis points from the cost. I think we have a long way to go on the cost side. We have just started because the cost, we are not into a cost-cutting game. It's more like driving efficiencies and finding new ways of conducting business. So that itself would drive the efficiency. So I think we would have kind of started maturing on the cost side of the business in another 14 to 16 months, as some of that requires remodeling of the spaces. It requires the remodeling of the kitchens, the whole journey of, from a receiving to a storage to a production to a service supply thing. So I think all that is a very significant part of that cost journey.
I think if I may just add to what Puneet has said, I think if I sort of look at the numbers, our raw material cost in standalone actually degrew by 1%, and payroll cost remains flat, and fuel, power and light also remain flat. So I think on all these three elements, we were able to maintain the cost. Our corporate overheads also were broadly at a flat level. In fact, we were able to save some, even though our top line went up. So we continue to keep a tight focus in terms of cost action.
Thanks for that. Just like one follow-up on that, essentially the reason for the question being sparked is that, this year you have already had almost like 250 bips of consolidated EBITDA margin expansion on a YOY basis. And so then to go to your target of 25% margin by fiscal 23, the incremental run rate required is lower. So that's why one is trying to understand whether, a lot of cost control has already happened this year, and going ahead, are we going to see lesser benefit from cost control, or would you not agree with that?
I think, Satya, if you are wanting to ask us if we want to give a higher guidance on margin expansion, then we need to wait, as we have said last year, the same. Q1 and Q2 in any fiscal year is not the time to give the guidance because the majority of our business is in the Indian subcontinent, and what determines the performance here on absolute terms and margin terms is mainly Q3 and Q4. We remain confident that we'll be in line with whatever we have communicated, and if there was an improvement possible, we'll give that guidance as we come towards September, October.
Great. Thanks a lot, Puneet. Thanks, Giri.
We'll take the next audio question.
Hi. This is Vikas from HSBC. Can you hear me?
Yes.
Yeah, sure. Sure. So thanks for the opportunity, and congratulations on closing FY19 at a double-digit growth rate. My first question is, we have been able to achieve this kind of growth after 7 years. So how confident we are that we can maintain this kind of growth going forward? And also on this 10% growth, how much of this was contributed by the new rooms addition? So I'm looking for like-to-like growth, how much, what that number was. That's my first question.
Yeah, I don't think there was a big impact because of the new additions. As I mentioned, 3 of the 5 hotels opened in Q4. All 3 are on management contracts, so they are not even, 6 months in operation. They're in a kind of a soft opening phase. That's the Vivanta in Kathmandu, the Taj in Theog in Simla, which is not in a seasonal period, and the Taj in Rishikesh, which has been in operation for less than 6 weeks. So I think that's the 3 of the 5. And then there was 1 in Qtr, which is undergoing serious renovations. So mainly you can think that the 10% growth for the year is more or less like for like. I think the growth story becomes interesting as of this year, where I said we'll be opening a hotel every month. And as we go forward, as I said, we'll do by brand and by geography. We will also start giving, kind of comparison on like for like and total. Because it will have some impact on our occupancies and rates. The more hotels we open new, the more they're in the stabilizing phase, they might dilute our RevPAR or occupancy, which is very normal for a growth company. And so that would be very important. We will start giving you guidance as of next quarter on that.
Sure. And secondly, sir, how is your direct booking shaping up? Just if you can give us a trend in past few quarters. Are we being able to build on our direct bookings, because we have talked about the digital channel in the past? So yeah.
There we saw a lot of traction and improvement in our direct booking, especially during our winter campaign. Through our advertising, and the total almost reached through our reservation center worldwide and our own website to almost 22%. And that's quite a healthy number. I mean, there is a good growth on that number. And maybe, Giri, you wanted to add something.
I think 22% on the reservation network and website is a good number. And HRO, which is a hotel reservation office, is 48% of the business in any case. So therefore, we continue to make progress on our web strategy and also through our loyalty programs.
But that number, in corresponding to the growth in the portfolio, will not show much change. I think for us, it is important to keep promoting our own website, to keep promoting direct relationship with our customers. However, that's the state of the industry. I mean, it's not that it's that others have their share too. And actually for us, I would say it is a big help outside of our domestic markets, so that our reach in places like New York, London, Cape Town, Dubai, many other places is much higher when we have a third-party business channel possibilities to add to the revenue or to sell more room nights.
Sure. Thank you. I just have one last question.
But also one number, if you might be, sorry, I just got an advice from a colleague. there is one number if you want to know. Overall website revenue has increased by approximately 11% for us in 18-19 compared to 17-18.
Okay, 11%. Sure. Thank you. And, sir, one last question. I mean, this quarter, the employee cost increased by 13%. And going forward, I mean, what are the margin lever left for achieving our aspirational target? I mean, that's my final question. Thanks a lot, and best of luck.
So the payroll cost, sometimes increases in a certain quarter because certain of our properties have a wage settlement. It does not happen, we don't average it out for the year, so I would not like to look at it on a quarter-by-quarter basis. I think it's good to look at it as a percentage of revenue for the year. And certain wage settlements cost more, certain cost less. On our standalone, it's just flat. There is a 0% increase in the labor cost, and we don't see that trend changing going forward. Despite increase in wages, as we said before, we'll keep looking for new ways of business models, leveraging technology, etc., to remain efficient and relevant.
Sure. Thank you.
We'll take the next audio question.
Yeah, Sriram from Sundaram Mutual. So, what was the ARR for the standalone entity and the room revenue for the year, for the standalone piece? If you can give the number.
Yeah. For the standalone full year is what you're asking, Sriram?
Yeah, yes, sir.
Yeah, the ARR for the full year was about 11,000.
And the room revenue, absolute number, full year for the standalone entity?
The room revenue full year number is about 1,165 crores.
Okay. And, sir, the corporate negotiations, how did it go? If you could elaborate on what was the ADR increase that you had were able to, take on those front, and how do we see the ADR shaping up forward? And the coming quarter, do we see some kind of disruption on account of the slowdown on aviation traffic or something?
Yeah, I'll take, so the corporate business for us is only about 14% or so. And in terms of negotiations, we've had about 4 to 5% increase in rates. So I think which is consistent with our expectation in terms of what you say, the rate cycles. And in terms of aviation disruption, I think we do believe that capacities have been built up. Of course, costs have gone up. But the first quarter is a little difficult to predict because of elections and all that. But nevertheless, let us see. I think it should settle down is what we believe.
Okay. Fine, sir. I'll join the queue. Thank you.
We'll take the next audio question.
Yeah. Congrats, sir, on good set of numbers. This is Qtr4 from Sharekhan BNP Paribas. Sir, what was the occupancy expansion for FY 2019 and for Q4?
Sorry, could you repeat the question, please? Couldn't hear it clearly.
What was the increase in the occupancy rate for FY 2019 and quarter 4?
Yeah, the occupancy overall was about 68% or so, which grew by a little under 1% for the full year.
For the full year. And what could be for the quarter?
For the quarter, I think we saw a very good rate increase of nearly 7% or so. The occupancy took a little bit of a dip in Q4, about 2% dip.
Okay. And what could be the reason for the same for quarter 4?
What could be the reason for the same? I think, can't pin it down to specific factors, but definitely I think
there is one thing is, for what we experienced was in the month of March, after 15th or 16th of March till the end of March, there was a significant slowdown in pre- and post-Holi. That's the only thing we have seen. That there was a slowdown. There was a similar slowdown in October because Diwali was this year a bit later. and so was that with Holi being a bit later. But then December came out very strong, and so did January come out very strong. So March did see a dip on that, and because March has 31 days, it becomes even more relevant because February has only 28. It does have an impact if you lose 15, 16 days in March.
Right. So in your presentation,
and I think also in the month of March, if I'm not wrong, there were 4 or 5 weekends. I mean, not 4. I think there were 5 weekends. It started, let me just confirm that to you in a second. Yeah. The month of March started on a Friday, and it ended on a Sunday. So there were 5 weekends in that month.
In your presentation, you mentioned that there is still a gap between the demand and supply. And for FY 2020, do you expect that gap to sustain, which will help you to see another good year in terms of better RevPAR?
Yeah, I think so. I think the supply-demand gap is more structural actually, because you do see new supply, especially on the luxury side, taking much longer to come. As far as demand is concerned, we are actually very positive on demand because of all the international passengers coming in as well as the domestic passenger traffic. We see that demand is likely to kind of surprise and supply constraints will continue to remain. So I don't think it is a one-year event. This supply-demand gap is likely to be over the next medium term, at least 4 to 5 years.
Right, sir. So just to ask a second question on the same term, then the ARR growth for this year, it was 2.9% as per the presentation what sir gave. So should we expect that ARR growth improve for the second half, considering the second half is the key period for the hotel industry in India? So should we expect next season to be good in terms of ARR?
I think what we have said is that 2.9% in the presentation is more the overall industry. I think we have always guided to a RevPAR of about 6% plus. So therefore, I think we should continue to maintain that 6% in kind of RevPAR. Though there may be variations. Example, Q1 may be a little different. But nevertheless, I think 6% is a fair RevPAR to go after.
Right. And one last, if I can keep in. Sir, international properties did well for you this year. We have seen 10% growth in the revenues. So can you throw some light how the performance would be in FY 2020, and what was the key highlight for FY 2019 in terms of performance?
I think on the international properties, all the properties did very well. In fact, I think we continue to focus on US, the Pier, the Captain, as well as St. James Court. I think all of them have done very well in terms of business performance. You want to add anything?
Yeah, I think despite all the news on Brexit, we are very well positioned in London to take benefit. San Francisco is doing very well for us. We've been able to improve significantly the performance in Pier. Dubai is stabilized at a low level. It's been under distress. So generally speaking, we think the international, and it started also very well. The international properties in the month of April have till date done quite good numbers on the top line. For us, we would be happy if this trend continues, but I don't think anybody today can judge with certain amount of, confidence what is going to happen in London, what is going to happen with Brexit, what else will happen. So I think I can only say as figures stand today, everything is looking good, and we feel we are very blessed to be present in the two largest lodging markets of the world, namely both London and New York.
Right, sir. Okay. Thank you, sir. I will get back into the queue. Thank you.
We'll take the next audio question.
I think while we wait for the next audio questions, there are a couple of questions which have come on the slide assist. Let me take them up one by one. I think question number 1 from Salil Garga is, what are the plans for capacity addition in FY20? As we have clarified, we have signed a number of management contracts, and we expect to kind of, open a hotel every month. So if basis that plan, I think in 1920 we should open approximately about 1,800 rooms in the current year actually.
Yeah. I think assuming 1,800 to 2,000 rooms in operation this year would be what we can provide guidance for.
Correct. The second question, which is there on slide assist, is how do you classify the rooms between owned and under contract? And what is the number historically and what has been the trend? I think the management rooms are around 4,900 out of the 17,823 rooms. And owned in IHCL is about 4,350 rooms. And in the group, we own about 8,500 rooms. I think these are the two questions that I had on slide assist. I don't have any other question on slide assist.
Yeah. Hi, this is Shaleen from UBS.
Yes, Shaleen.
I hope I'm, yeah. So, Giri, if I heard it right, you said 7% ARR increase for this quarter?
We had a 7% ARR increase for this quarter, fourth quarter, standalone.
Oh, standalone. So, any sense on Concall?
Any sense of Concall is a little hard. I think you will have to look at it more in terms of the network actually. I think it is because Concall, what happens, Shaleen, is that it gets consolidated differently. Like Orient Hotels will come at a one-liner. But I think if I sort of look at it from a domestic perspective, the room revenue did grow by around 8% on a network basis, and ARR did grow by 6.66, more than 6% actually.
Got you. Well, that's very impressive actually. So the corresponding number, if I go by my notes for last quarter, was 4.6%, and this year we are talking about, this quarter we're talking about 7%, and that's the reason we are seeing a significant jump in your EBITDA margin for this quarter in the standalone. So there is a deflection. Your EBITDA margin has improved significantly from last quarter in standalone, but not so significant in the consolidated, and that's the reason for this. No, great. So that's I want to understand. So pretty much in the right direction. Most of my questions have answered. One question I want to understand. If I look at your PAT, you're doing at Concall level around 280 crores. Depreciation, we are doing roughly 330. So 600 crores of cash flow without considering the working capital we were able to generate, and our debt has also increased marginally. I mean, when do you think that you will start reducing the debt? Because I don't see much of the capex also happening over here.
I mean, I think we continue to be very strongly focused on debt, Shaleen. I think as we saw that the consolidated debt to EBITDA was about 2.11 and our debt to equity was about 0.44. I think what we are now seeing is that the cash from operations will be good in terms of meeting all our requirements actually, and then of course we continue to focus on whatever we can do on asset monetizations as well. So while we are getting some repayments of debt like debentures coming up in the current year, while we are planning to refinance, I think we will probably see as we go forward with some monetizations also, we could bring it down. Our target is to bring down the debt to EBITDA and debt to equity further during the current year.
Sure. So what's the capex plan for this year and the coming year, FY20?
The capex plan?
The capex plan always stays the same, which we have given the guidance. One is system-wide and one is the revenue that is reported. So typically anything which is 4 to 5% of system-wide revenue, if our revenue system-wide would be around 8,000 crores, then you can assume 350 to 400 crores as the total capex expenditure. If you want to take only of the reported revenue, which is this year 4,600 crores, then it will be around 250. So that's a very standard amount that we have. I think we would be operating within that level. That's a standard accepted guidance globally for the hospitality industry.
Sure, Puneet. And the last bit of the 12 hotels which you're talking about, all will be management contract, or is there any of them is a part of a group or IHCL?
There is one which, if all goes well and opens in time, is the Connaught in Connaught Place in Delhi. We are hoping to open it by end of January or early February, so it would have been open for 6-7 weeks for this financial year.
Sure. Cool. That's it from my side. Thank you so much and best of luck.
Thank you, sir.
We'll take the next audio question.
Yeah, hi, Sumanti Kumar from Motilal Oswal. So for FY19, hi. So for FY19, subsidiary EBITDA, the console minus standalone, was around 100 crore versus around 42 crore previous year. So could you please discuss the key subsidiary performance, how the key subsidiary like US, UK and other domestic subsidiary like PM performance for the year and for FY19?
Sure. I think fundamentally, one of the things we are focused on is to make sure that not just Indian hotels, but also all the other companies do well. So if I look around the patch, I think PM Hotels has definitely done better. In fact, their performance top line went up by around 16%. I think those you will see in the subsidiary balance sheets coming through. Roots Corporation also improved in terms of top line. Banaras Hotels is a small company, listed company, that also went up significantly. The U.S. top line went up by actually 17%. St. James Court Hotel also went up by nearly 19% or so. That went up by around 8%. So I think across the patch, you will see that all the hotels have all the entities have performed positively. So therefore, we will see overall improvement through the line.
So when you talk about the 17% growth in U.S. business, so is there any improvement in operating performance?
Yes, there is. There is actually. So there is clearly.
Could you please quantify the EBITDA of the respective subsidiary like US, UK and PM?
Yes, of course, yeah. In fact, I think if I just look at the Pierre Campton Place and St. James Court, I think the swing in performance is nearly about, 6 million or so in terms of the swing. So therefore, that is a very, very strong swing in operating performance.
So $6 million US you are saying the swing in the EBITDA?
Swing in the EBITDA, yes, it's a little more than 6. In fact, it's about nearly 7 million actually.
So I think the EBITDA loss...
And the cash profit level went up by around 7 million or so in these three hotels, which is Pierre, Campton and St. James Court.
These are the three hotels that are driving the international performance and, are very relevant in our margin expansion story as well as our absolute improvement in EBITDA.
So what is the EBITDA loss for US business in FY19?
Yeah, the EBITDA loss is just under 9 million.
9 million?
Plus, it's only Pierre and Campton, sorry.
I think if you add, the profit in one and offset it against the loss of the other, we are talking about a positive of 4.5 million for these three hotels together, Pierre, Campton Place and St. James Court. It's around 4.5 million positive.
Okay. And what about the PM EBITDA?
I think we can take that offline. I'm not sure if we can give individual EBITDA for every property. We have confidentiality clauses with certain owners and co-op, and we don't want to be in that breach.
Okay. So
as this hotel is owned by a co-op and we are a tenant.
Okay. So talking about the Q4 performance of subsidiary, I think it is a flat. The EBITDA loss was at the 10 crore and at the same level of the previous year. So what was the key reason where we have not seen an improvement in the key subsidiary like PM and US and UK, or losses in US has increased in Q4?
I think maybe it's got something to do with the change in currency. Otherwise, if you actually look at the amount and put that 10% depreciation in the currency, would be the same.
Okay.
But also this we can get back to you by tomorrow.
Okay. And talking about the for Indian hotel, we'll have what will be the impact on the Ind AS 116 on our return ratio on the new accounting policy?
So on Index, we are kind of evaluating it. We will have a separate conversation around the impact of Index. Clearly speaking, under the standard, all the leases are now being classified as financial leases. And therefore, directionally, what will happen is that the lease rentals will go below the EBITDA line, and therefore the EBITDA percentages will improve. Having said that, the depreciation and interest would come through, and therefore this will have an impact on the PBT. On the balance sheet side, there will be a capitalization of those leases, especially where there are fixed leases actually. So this is something that we are still in the process of evaluating, and we will kind of talk separately on that. Okay.
And so for Q4 FY19, you talked about the dip in occupancy by 2%. So what was the occupancy in Q4 FY19 for a standalone business?
The occupancy in standalone for was about 70. Last year was about 75.8 or something like that. 76 and 74. Yeah, that's correct.
76. So this quarter will be 74%.
Correct.
Okay. And you said the 2% decline in occupancy, and the standalone business have a growth of, say, ARR growth of 9% in this quarter?
No. I said about 7% or so in this quarter.
7% growth in ARR?
Yes.
For a standalone?
Yes.
Okay. Thank you so much.
We'll take the next audio question.
Hi, this is Bharat Seth from Quest. Congratulations on good set of number. Puneet, we are talking of adding around 1,800 to 2,000 rooms in FY20. So can you give some color which brand will be more, and how do our portfolio mix will change, and which geography, if you can throw better color?
Yeah, almost all the hotels will be domestic, and almost you can say 900 rooms will be added under the Taj brand.
Okay,
another 500 under Selections.
Okay, great.
And we are hoping a minimum of 500 rooms also with Ginger.
Okay. And when do we expect, that Santa Cruz Ginger to come up? What is the status at this level?
Sorry, I couldn't understand the question.
See, we have, we're working on opening a new, Ginger at airport in Santa Cruz.
Yes.
So what is the status of that?
So we are progressing, and we are in the final negotiation with the general contractor for the terms of the construction of the property. And we are awaiting the final, planning. The preliminary planning approval has been granted. And then now we are going for the final planning. It will take at least 2.5 years to open. But it will be a real flagship property with 375 plus rooms.
Any color, how do we look at, ARR for FY20, overall for domestic and international business? Both separately?
I think you should go by the guidance that we are talking about is that, our 6% RevPAR is probably a fair guidance.
Okay. And you said that pre-Holi and post-Holi, we see some dip in occupancy in Indian market, domestic. So how was the April,
How was April?
I think April and May, both months are significantly impacted by the elections. So, for example, you do not get government delegations visiting heads of states. I think all that will start coming as of June. So there is also last time, I'm told by my colleagues, when there was elections last time, we saw similar trends. In April, we have not seen a dip versus last year. We're more or less flat in terms of revenue. May and June, we will see what happens. June outlook looks very good. So it's only, we have to see, and April was okay. We have to see how May will perform.
Okay. Thanks, and wish you all the success.
Thank you.
That's all.
What I will do is that there are a couple of questions which has come on the slide assist. So let me take that. One is that what is the reason for the increase in other income? I think other income includes the sale of apartments, about 14 crores or so. So that is kind of included in other income. Then the other thing is, second question is throw some light on domestic subsidiary, but that is something that we have answered in some of the earlier questions. What is the growth in foreign guests in India with respect to foreign tourist growth in India? I think...
I have to ask that Horwath Consulting or STR.
Correct.
Because we get that data historically. I don't think they've come out with that data for the last financial year.
Yeah. There is a question on what is the management contract revenue for FY19 and what is the total pipeline of management contracts from Deepika. I think the management contract revenue was about 157 crores or so, which is the base, and reimbursements were about 66. In all, beyond about 222 crores on management contracts, including fees, actually. And that pipeline of management contracts, as we mentioned, we expect to open one hotel a month, and most of these are management contracts. Pragati Maidan, of course, I think there's a question on the update on Pragati Maidan for it. I think we did not bid, so therefore, ultimately, we are not in the project actually. And the other question which has come is, what are the initiatives taken to increase food and beverage revenue across properties, and what are the expectations for FY20? I think our F&B growth continues to be strong, double-digit growth. This is driven by both restaurant income as well as the banquet income. They continue to be very strong. So we will continue our efforts in terms of driving this. I have one more question. JV and associate performance we spoke about. Guidance on 20 EBITDA margin expansion. I think it's in line with the aspiration. Sale and lease back on Ginger properties, not as yet, and that is something that is on work in progress. I think we have another 5 minutes or so. For the last couple of questions, perhaps.
All right. To all your participants, if you find that your question has been answered, you may remove yourself from the queue by pressing *2. Okay, we'll take the next question. Please go ahead.
Hello.
Yes, can you?
Yeah, thanks, sir. Thanks for the opportunity. So can you just outline, there is an item assets held for sale in the balance sheet. So what is it pertaining to? As of FY19, around 84 crore.
This is basically residential apartments. Some of these have been held for sale, nothing else actually. Which is 8 crores.
Okay, and this is, 8 crore. And okay, and this will be more, and these are residential apartments?
Where employees stay, we have, as we have always said that we are selling our residential apartments where the employees are staying. So we have sold about 2 in the last quarter, and we have sold 1 in the current quarter. And this is something that we will kind of monetize as we go forward.
Okay. And secondly, sir, if you can just provide some guidance on tax rate. Well, it has been trending downwards, but if you could just provide some color on tax rate, either at console level or at standalone books level.
I think standalone is more relevant to look at it, because I think 37% is the standalone tax rate. I think standalone will probably head up a little bit next year, because what happens in standalone is that because we take if we take an impairment of US losses in standalone, and this year the losses provided were lower, and those losses do not get a tax deduction. We got a benefit where the tax rate went down from actually 48% to 37%. We expect the standalone tax rate to probably head up to 40% or so. I think that's probably a number that you should assume. We don't get a tax break on that. We have been working on that.
Okay. And so I'm just trying to understand, why is it higher than in the corporate tax rate? Is it especially in the standalone?
Yeah, basically that's what happens. I think the 35% is the basic tax rate. Because we don't get a tax break for US losses, so that takes it up actually.
Sir, I'm talking about at standalone level, only on the standalone books level. 40% is the guidance for standalone, right?
Yeah, because, standalone, what happens is that to the extent that there are cash losses in the US, we fund from here. Earlier, when cash losses were funded from India, we were used to add it to the investment account. We stopped that practice roughly around 3 years ago. And therefore, what we do is that to the extent that there are cash losses, we charge it off in the standalone P&L. Because it's a US loss which is charged in the standalone P&L, we don't get a tax break for that. That is the reason why. Yeah.
Okay, sir. No issues.
Actually, an investment through our international subsidiaries.
Sure. And so, just last question. Basically, this quarter subsidiaries performance has been quite slightly weaker. Means there has been losses in subsidiary versus the first 3 quarters where we saw healthy performance. Anything specific over there?
No, nothing very specific, to be honest. Actually, I think no, we didn't say anything specific in terms of subsidiary performance.
Okay, fine, sir. No issues. And that's it from my side. Thank you.
The losses. We don't see the losses. Anyways, so. Very good. Thank you.
I think if there are no other questions, I think I would like to close the call. And if there is any follow-on question, don't hesitate to reach out to us, and we'll be more than happy to sort of clarify that offline. Thank you very much for your participation.
Thank you, everyone. Thank you for joining the call, and we look forward to speaking to you in the next quarter.